money, who will incur that expense, have fiduciary responsibility, and take that off your plate. I have a friend who got a major payout, very smart guy. He wanted to play golf. He hired an outside manager, and that's all he did. But it depends what you want to do personally, and what you want to build. What is the objective? In terms of opportunity set, I'm still more opportunities.
Thank you, Mr. Clark. And going back to Derek, one of the things I love about your company particularly is that you don't only have a domestic approach, you also have an international one too. And I think it's very important to consider the China price levels that we're dealing with. So it's good to see what opportunities abroad are you guys going to look at.
I would say with Latin America, this specific region that we should pay attention to, simply because if you look across in Asia, we also do Europe Ukraine.
Can you speak into the mic a little bit closer?
And also to the Europe and Africa, obviously the infrastructure it has to be there. But there are already an opportunity in Africa already. But for us, considering we're already familiar with what's happening in Latin America, so naturally we feel like we're more comfortable looking into that region. And also you have to consider in Europe with the war in Ukraine, and also we don't know what's going to happen. Especially this year, we might see this. Probably it's not going to happen, but it's that unpredictability. It is there. So in order for us to kind of hedge against that uncertainty, we have to look somewhere else. In Asia, and that's another issue. We don't know what's going to happen between China and Taiwan, right? That's the serious issue. Nobody really knows what's going to happen. So it's like just before Russia invaded Ukraine, nobody really can say, yeah, Russia is going to invade Ukraine. Then let it happen. And you create really huge.
But now we're going to go to Singapore.
Exactly. And so, and then you just look at around the world and you see Latin America. Right? Latin America, they especially Brazil and Argentina, and you have the certain infrastructure already in place. And also, if you look at a commodity, because Latin America, they do have certain regions that they produce the commodity, copper, all that stuff. I think that's definitely worth looking into, especially if you want to have type of direct investment. As mentioned, we also looking into. I think that's one point. Also, a lot of the family offices right now they're looking more into direct investment, whereas we used to just do a lot of fund investment, Yeah.
Well, to that point, I want to ask Scott this is a family office conference, so I'm curious to ask you, Scott, you guys transitioned from a hedge fund to a family office. What was the reason for doing so? What was the advantage of doing it?
The reason was, again, we were managing a distressed strategy, and 2017, 18, 19, there just wasn't a lot to do. And to the credit of the founder, he just wasn't comfortable collecting fees on a strategy that he just did not see returns. And to move to the other point, which is what are the advantages, if you've ever been involved in a hedge fund, you ever managed a hedge fund, you go out and offer document and tell people how you're going to invest. That really, holds you into a tight pattern if you're doing your job. So we didn't feel that we were at liberty to start looking beyond what we said we were going to do. So put those two together, it's like, all right, it's time to return capital. Can't do what we promised we were going to do, so it's time to give it back. And there's also a point in the principles life where you'd be like, maybe it's a tremendous responsibility managing other people's time. Again, if you were honest about it, good about it, and it was time for him to say, I don't need to do this anymore. We did it for about 30 years. And as a family office now, we have the freedom to invest where we see the opportunity. We don't have to worry about we have an offering document that says we're only doing fixed income and a distressed strategy. Now it's like, all right, well, there's nothing to do in that space. So, we do public equities. We also took, as I said, we manage about half the assets internally. We took the other half, and we actually are looking for, we just some of it to outside managers, looking for sort of unique opportunities. Again, usually in a fund format. But for example, we just recently invested in a group that we're doing distressed hospitality. With a lot of, my sense is I spent a lot of real estate folks on it. We don't pretend we're not real estate folks. And I think it's the worst thing we can do is start trying to do things you're not good at. But we identified a group that they know what they're doing in real estate, in hospitality years ago. So, we're doing a mix of those things.
Wonderful. And so maybe just jump with you real quick. As someone who oversees over $1 billion in AUM, what are your expectations of the next Fed meeting? And what do you see in the foreseeable future as far as earnings, as far as so what do you guys expect to occur?
Yeah, it looks like Adam Smith's invisible hand has been replaced by Jay Powell's bulging muscle on the bicep. And clearly, I think I'll start with the consensus the statement of the United States is expecting or is in a recession or will be in a recession. In the foreseeable future. Our expectations are, this is again, certainly starting with the consensus first, which is this is what the consensus is that, there's a deteriorating housing market that is, and we're going to start to see the consumer weaken. And that is going to have an impact, and obviously with the rise of interest rates and the impact of inflation, which is compounding between 6 and 9%. Our expectations are that corporate profits will start to decline. That is the consensus view on the United States. Going across the pond to Europe, Europe has got many issues and many problems, particularly being short physical energy, and that is not going to end anytime soon. And we are all aware of the events that are going on in Europe, and we don't need to expand on that. Third is with respect to what's going on in Asia and in China. China, CZ has come back. There's expectations that he would, whether or not he would soften on zero COVID policy, TBD. But that is sort of the lay of the land and consensus. And generally, when you're investing, and obviously the expectations are that the Fed is going to continue to raise rates. They have to because we still have a negative real interest rate, right? So today, 3%, 3.25% versus 8 or 9% in terms of inflation. So we still have a negative 5% sort of negative real interest rate. Obviously, the belief is that this is going to continue, although there's been suggestions today in the Wall Street Journal that we're think Godot has finally arrived, in terms of being here. So, in terms of a pivot or a pause of some sort. But even if that is the case, inflation will continue, and we don't see that ending anytime soon. So that is the consensus view. So what do you do in that environment? Obviously, if you want to outperform, whether it be in the public markets or in the private markets, you have to have a different view than the consensus, and you have to be correct. So we are not comfortable having the consensus view, and so that's not something that we align ourselves with. And so the different view is that 22 is an outlier year, right? One goes back and looks at history, going back to 1928. There's only been 6 times when the S&P dropped 20% or more, and only one time in 1930 where it didn't rally 20% after that. Obviously, investment grade was also down, I think 15% this year. It's also problematic with that negative wealth effect. But this too shall pass. And so we are leaning more towards the bullshit.
Wonderful. And then leading up to my next question, is Fordham, I know you know very into real estate. What are your thoughts on real estate today as an asset class? Are there any particular niches in real estate that you're interested in?
Depends on what part of the portfolio you're dealing with. Dealing with distressed hotels before COVID restrictions got lifted, or you're dealing with multifamily that has had continued pressure? Are you dealing with industrial who may have sector that may compete because of
Well, where do you see the opportunity? Which asset class and which geography? Okay, thank you.
I also have to look at geography. Multifamily is the safest. The pressures in multifamily remain fairly high. Well, what is your investment period? Right? Is it a short term, let me fix it up and.
We're all long-term buyers here.
Well, long term, I haven't bought anything new in a little while
Well, that's your season.
because of my concern about overpricing. And a concern that if we do have a recession in 23 or 24, it doesn't work in a perfect synchronous up or down. You're gonna have things that are in the system now. Talk to Jeremy Siegel at UOP, he will say there's a lag time, you're not seeing it, the statistics are missing what's actually happening in the market. I haven't seen that yet. You still have sales going in condo space and rental. If they come down, they come down honestly. So what do? If you're a long-term player, you can go out into the opportunistic side of life. You look for strong, well-located land that you can develop into what you forecast is going to be a durable asset class in that location.
Scott, I know you don't stranger to this area, you want to expand on this? Is now time to start with the trust fund?
I'm sorry, sir.
You want to expand on real estate?
Like I said earlier, I'm not, we don't pretend to be real estate experts, that's why we tend to give it to other people to manage it. I think I'm sort of agreeing with Joe in the sense that, it really depends on the opportunity set. It's just, one of the things that attracted us to, just, distressed hospitality. These guys started it, and not surprisingly, during COVID. And they looked at me, one of the founders of this fund is a former distressed hedge fund manager himself. And they looked at this and they said, this is not gonna last forever. And there were a lot of properties that were on the brink pre-COVID that just got pushed over and they bail out.
I did bid for some,
Yeah.
in the hotel space particularly.
Mhm.
But I found that the existing players and the senior lenders who are already in the asset, they weren't gonna let that feature get away. They basically recapped themselves into a mess.
Well, I think, I definitely see that happening, but what's interesting about the bank center, I'll keep it, you still have somebody who's gonna run it, and that's why we like these guys. They're an interesting fund structure, and that's, they're going to typical, let's get 5 MBAs together, and we all be smart. It was just, they have an architect for the mortgage, they have a guy who's literally in the food and beverage and the hospitality business. So, they have designers, and I went to their office, their offices are right here in the city, and they literally have tables filled with fabrics, sheets, curtains, wall covers. These guys are operators, and that's what I really like them. It's like, because they want to take a rundown 15, 20-year-old hotel that probably needs a deep facelift, and they'll do it, and they'll position it. And, yeah, I'm not sure I answered any of those questions.
Oh, that's perfect. So Jennifer, with that being said, if you're looking at an operator or a manager to invest in, what attributes are you looking for in that individual? And this, I'd love if you can go back on this question as well.
Because I want to expand a little bit on the recent when,
I was thinking, because you and I were working on a hotel recently.
yeah, because we look at a hotel. Because I think there's one area that, I also share that with the group when I was here to it's a warehouse. I think we consider the supply chain issues that we experienced, especially in the early 2021 and 22. Then we have this, because we have close to 200 vessels docking near the port of LA and Long Beach. They just couldn't get in, and all the warehouses basically near the West Coast is completely full. So our family is part of our family business in logistics. It was really difficult to get the container in and out of the port, and also we have to find a warehouse in Idaho to park our container. Then, because Idaho, in order to get our container there, we have to use rail. I mean, probably a lot of people already know the rail system here is really, for the lack of better word, is slow. It's really slow. So it's extremely difficult to move a container in and out of the port, even out of the rail yard, and let alone all the warehousing business before we cannot bear empty warehouses. So that's just in terms of how in demand the warehousing is. But at the same time, it's very difficult to operate a warehouse. It's really operationally intensive. And you need a lot of labor, you need a lot of overhead, expensive. So it is an interesting asset class. It is an interesting area to, if you're looking for the long term, I would assume warehousing is definitely one area that should really consider. But at the same time, keep in mind, it's not that easy. Just like Bruce said, you have to find your location.
I think it's like what's Scott was saying, you really have to partner with somebody that actually has experience in that industry. So
yeah, just like when you mentioned like we're looking for a partner, obviously the track record, right? Obviously it has to be, the track record has to be there, so we know who we're talking to, what we have done, especially in terms of the project they propose. And with that said, then we have to know that they do have the expertise, right? The track record has to be proven track record, or that they have successfully closed certain deal. Well, obviously there's no number of the deal you have to finish before approaching us, but at least they know what they really talk to. Then the next part is our part. Basically, we could do our due diligence. We talk to guys like the staff, right? Just to find out, hey, do you guys have you guys heard about this guy? What do you think about him? That's usually how we take this deal to the next level. If we can't pass the initial due diligence, we probably not going to bother.
I love it. And it sounds like Derek's ready to write checks, so watch out for this guy. We're going to take questions soon, so I should see some hands going up. Let's meet. Do you want to ask a question?
Yeah, absolutely. So we generally invest thematically first. We come up with an idea, and then we start canvassing the universe on whoever is invested in that strategy. And to Derek's point, we obviously look at track record, we look at their experience, et cetera, and even references. The earlier panel talked about network. Your net worth is a reflection of your network, right? So, and not just in terms of financially, but mentally and spiritually as well. And so, I would encourage all the managers in the room, be careful who you put down as references, and make sure that that they actually are going to be references for you. You'd be surprised what people tell and talk about and say behind your backs. So
That actually happens.
In a different context, it wasn't an investment context, but I asked for references on something, and I called one, and the person then proceeded to trash the outfit that it was a reference for.
And that's so just be mindful of that. And by the way, it's not that when we do our diligence, it's not that we're just limited to the references. We're obviously going to do our own outside checks, but we've had a couple of instances just recently. It's come up. It's a case in point. So.
It's interesting to listen talking about the various asset classes or areas to go. One of the things that attract us in venture, and we do get sent a lot of prop tech and fintech related to prop tech because we have the experience in that space. But venture covers so many areas, and if you have a broad enough feed into you in terms of deal flow, we are concentrating now on earlier stage, so we're trying to make assumptions on market developments over a long period. But we have in our portfolio late stage investors as well. So we use them as cross checks and as a way of adding value to what we have. But there's almost no area that I can think of that is not impacted by tech. And that sort of accepts us.
Wonderful. Thank you. That's all.
Thank you so much. Wonderful comments. I have a question for Sumit, or maybe Derek also talked about the international investing. Would you invest in Europe at this point, or what would make you invest in Europe? we understand that there are problems with the war going on. At what point would you consider investing? Thank you so much.
So, use the Greek as a reference, they believe that the world came out of chaos, right? So, versus, the Big Bang Theory, that's how mythology started in Greece, right? And so there is chaos right now in Europe. Europe has 450 million people, $19 trillion, economy or so, plus minus, and, it is 20 to 25, 22% of the world's production. There are tremendous opportunities in Europe right now. There's a lot of babies being thrown out with the bathwater. We are investing in Europe. We are finding opportunities. And of course, it's easier said than done. We've also made mistakes. We didn't hedge properly. Guilty as charged. But there are tremendous opportunities in Europe. Those who have a long-term view. We had a little bit of an issue yesterday in terms of Prime Minister resigning in the UK.
You're gonna be one of them.
Well, and by the way, she has a tremendous track record, right? So in 44 days, she's very the Queen, the Pound, as well as the Tory party, right? So with all that said, Joe, but with all that said, what is fascinating is that UK equities we think are becoming interesting, and we're actually finding opportunities there. So I hope that answers your question.
I have a slightly different view, if you're looking to the panel.
Yes.
I've looked at Europe, I've invested in Europe in a variety of different ways. It has never outperformed other sectors. However, on the venture side, there are emerging centers of tech, and we have done tech deals in Europe where there is an adequate infrastructure, an adequate talent pool to deliver outsized returns, and you enter at an attractive price relative to, call it 21 valuations in Silicon Valley.
I've got to believe that opportunity for tech in Ukraine is going to, because it was prior to the war, it was the tech center for Europe.
Oh, yeah.
Yeah, so the opportunities are going to be tremendous.
Couple of million talented coders from Ukraine. I'm Ukrainian.
I'm sorry, Tom.
So actually I have a question. Oh, go ahead.
So Scott, your distressed background, you've been through many cycles. How long do you estimate the high yield credit market will stay closed based on historic cycles you've been through? So basically, what, been closed since June, more or less?
It's interesting, when we're still doing our quarterly letters to hedge fund investors, we kept saying, the cycle's going to turn, 12 months. We put that out probably for 3 years. It's difficult. And we think we're probably going to see a turn in the near term, probably in the next 12 months. But we've been wrong before. The Fed has been historically, the Fed was very willing to bail out very badly run companies with very low interest rates. And that's what was different about this most recent cycle. I think that's obviously changing. And I think we're anticipating seeing a lot of companies are not going to be able to cheaply finance their way out of problems.
It's already blown out.
I apologize.
Yeah, CLO equities are yielding 5% per quarter. Triple Bs are SOFR plus 8.5 as of Friday, and double Bs are 15%.
So it's attractive.
Not sharing in my book.
We'll take a few more questions, Ms. Thompson.
Well, there is a disconnect today between buyers and sellers in the market, in every sector we have. What's your advice for the sellers that are holding to the pricing of 2019, 2020, and then for the buyers that are expecting recession to come in any day? So both sides are afraid of FOMO. Nobody wants to, miss out. But the seller is back against the wall because the refinance is around the corner, and his debt service coverage ratio might not cover. And then the buyer that is sitting on capital, unemployed, is also afraid to miss out. What's your advice? And I know nobody has a crystal ball except me. But what's your advice?
Well, since you are Nostradamus, we won't tell you what the future is like, but, neither a borrower or a lender be, right? And so,
Everybody has to have piano.
that's right. So, this is, the environment has changed, and there is regime change that has occurred. In terms of interest rates and expectations of what the past was like may not be the future. We're very bullish on credit, structured credit, those who can, lend, we're lending, and those who can create, and obviously you're going to be able to get better covenants, better lending terms, and if you are a seller right now, and if you have your back against the wall, these are the challenges that you have to realize. A lot of businesses are going to go away, because the economic environment is not going to get any better.
Structure is a key word there. So to bridge gaps between buyers and sellers, between companies that raised in the venture space, by way of example, money and did not re-up in 21 and make sure they had runway for 2 years. You're going to end up with companies going out of business, or if the company is attractive, you introduce capital structures, so the next guy coming in may put in, instead of a non-participating pref, and I'm happy to explain that if someone wants, maybe it becomes a participating pref. And instead of a 1x participating pref, maybe it's a 2x or a 3x, so that the investor coming in and the buyer and the seller are basically saying, I'm taking much greater risk. I want to bake in a much, a good return for my risk. But you're a believer in the business, and you're a believer in the opportunity. I'll leave this so that you continue to build your business or build your opportunity. And if you're right, you'll end up making enough money to make it worth your while.
Perfect, thank you. You start right there?
Yeah, so we've spent a lot of time talking about, long-term investments and that kind of stuff, but especially with rates rising, and maybe Scott, this is a good question for you. If you're sitting on a big cash balance, and banks have been slow to raise the interest income that they're paying on deposits, how are you managing your liquidity needs for the next 6, 12, 18 months?
Well, one of the nice things that's happened with Fed actions that treasuries are yielding again, finally. A year ago, 18 months ago, our cash was, yielding virtually nothing. But the treasury market now is finally becoming a little bit more attractive. So that's on the cash management side. On the invested side, we're still pretty thin. We still see a tremendous amount of risk out there for further market decline. And the thing about being a family office, and I'm not sure about my co-panelists, but just to be crystal clear, I'm not the family. It's not my money. It's someone else's money. And with that comes in, you have to have a tremendous amount of respect for their needs and desires. And one thing I do know is that capital preservation is absolutely paramount for the family. So that's a long-winded way of saying that's why we're so very defensive, because this is supposed to be around, not so that somebody go on like boat. It's supposed to be around so that somebody wants, because he wants to educate his great-grandchildren and do something there for them. So I'm not sure that exactly answers it, but it's a very defensive mindset, a very defensive strategy.
Fantastic.
I think I'll just piggyback on some of the stuff that Scott mentioned. And we prefer preservation over growth, at least from our point of view, at least for that's 5 years that time horizon. So in order to do that, we used to do a lot of the early stage ventures, but now since the high inflation is going to elevated high inflation is going to stay here for a while, So we looking more the deal that can generate steady cash flow, right? So to gradually build out a cash reserve instead of just putting all the money in investing into the fund or other type of debt fund and credit funds and wait until a couple of years and exit. Obviously, we still have a deal like that, but at the same time, we really find a way to generate the cash, steady cash flows, whether multifamily or housing or some other debt fund. Some debt fund do offer the cash. So I think that's one way to do it.
Wonderful. One last question, this gentleman right here.
Track treasurers.
So it's mentioned thematic investing, which is something dear to my heart because I have a wealth management company that specializes in thematic investing. And obviously thematic investing has been really popular over the last couple of years, more popular than before. And the focus has been mostly on innovations, things like ARC, ETFs, not that we can use ARC ventures obviously. And over the last 12 months or so, they've tanked right now. So I'm curious, what is your definition of thematic? Because it goes beyond innovation. Where do you see opportunities at this point?
Sure. So earlier I cited, cyber crime is one area that I think is very attractive. I think will continue to be attractive. Cloud and cloud related. And by the way, again, public and private. There are opportunities in private markets as well, and that's primarily where we've been investing in both aspects. The other area that I think is very interesting is deglobalization and regionalization. Derek cited about the problems related to Taiwan. Taiwan is 65%, in terms of semiconductors. They have a monopoly on semiconductors. Nancy Pelosi visited Taiwan. It was not to necessarily stick a needle in the eye of the Chinese, but it was primarily to bring Taiwan semiconductors to the United States. And so when you think about, and just last week, Micron Technology announced that they're putting $100 billion upstate. And that's a boundary, right? That's going to create jobs. That's going to create infrastructure here. Obviously, there's inflation related to that. There's labor issues, regulations, et cetera. But there's real estate opportunities. So, and it's happened with Intel and Brookfield. They did it in Ohio. These are just examples. And by the way, the Inflation Reduction Act, which I encourage everyone to read, is also, bullish around these types of themes. So, I think those 3 or 4 areas, credit, which I talked about earlier, cloud computing, I think cyber, and I also like this, and I do believe deglobalization and regionalization is going to occur. It's already started. I think it's going to accelerate, for the next 3 to 5 years.
Perfect. Thank you very much. Let's give a round of applause to our panel.